Here's the brutal truth that will save your trading account. Most traders don't lose money because they pick bad stocks. They lose because they add to winners like amateurs and cut winners like cowards. You've done this. Your stock moves up 5%. You double down. It moves another 3%. You triple down. Then it reverses, and your winning position becomes a devastating loss. This isn't bad luck. This is mathematical suicide disguised as confidence. The amateur sees green and thinks, more is better. The professional sees green and thinks, prove it first, then add less. This identity shift separates the 13% who survive from the 87% who blow up within 2 years. The difference isn't intelligence, market knowledge, or even luck. It's discipline. Mathematical discipline applied when your emotions scream loudest. Jesse Livermore learned this lesson in 1907 when he made his first million. While amateurs averaged down on Union Pacific as it crashed from $180 to $120. Throwing good money after bad, Livermore pyramided his short position. But not the way you think. He didn't double down on his winning shorts like every instinct told him to. He added precisely 1/4 of his original position size at each confirmation point. This mathematical discipline, not market timing genius, built his fortune. Think about what was happening in that moment. Union Pacific was collapsing. Panic was everywhere. Livermore had positioned himself perfectly on the short side, watching his thesis play out in real time. Every fiber of his being wanted to press harder, to bet bigger as the stock fell. But he didn't. He added exactly 25% of his original position size when the stock broke through $160. Then another 25% when it crashed through $140. Not because he was conservative, because he was mathematical. The counterintuitive promise. You'll build larger winning positions by starting smaller and adding less, only when the market pays you to. The hidden rule is the 1/4 pyramiding. Rule: you build positions in calculated increments, each addition exactly 25% of your original size. Only after confirmation, never on hope. This flies in the face of everything your emotions tell you about winning trades. Picture this scenario in vivid detail. You buy 100 shares of a stock at $50 after identifying a clear, pivotal point. You've done your homework. The setup looks perfect. The stock moves to $53 with volume confirmation, real institutional buying, not just retail noise. Your brain starts calculating. You're up $300. If you buy another 100 shares, you could be up $600 when it hits $56. Your emotions scream at you to double down. But here's what the professional does instead. Instead of buying another 100 shares like your emotions demand, you add exactly 25 shares. 25. Not 50. Not 75. Exactly 25. The stock pushes to $56 on strong tape action, clear momentum, increasing volume, institutional participation. Again, your emotions scream to add more. You're clearly right. The market is rewarding you. But you add another 25 shares. Exactly 25. Your position now consists of 150 shares total. Your original 100 shares at 50 cost $5,000. Your first edition of 25 shares at $53 cost $1,325. Your second edition of 25 shares at $56 cost $1,400. Your total investment is $7,725 for 150 shares, creating average cost of, for 150 shares, creating average stock $51.50 per share. Compare this to the amateur who bought 100 shares at each level, $50, $53, $56. His average cost is $53. When the stock pulls back to $52, his entire 300 share position shows a loss. Your 1/4 rule position remains profitable with a $51.50 average cost. This is the mathematics of professional position building. Your position grows, but your average cost stays low. Your risk stays contained. Your largest, most profitable layer remains your safest. The amateur transforms winning trades into losing trades through poor mathematics. The professional transforms small winners into large winners through disciplined additions. But there's a deeper psychological truth here. The 1/4 rule forces you to think like a business owner, not a gambler. When a business owner sees early success in a new product line, they don't immediately quadruple production. They scale gradually, testing market demand at each level. They prove the concept before committing massive resources. This is exactly what the 1/4 rule does for your trading. Waiting becomes a position. This phrase will change how you think about trading forever. Most traders think they need to be constantly active, constantly adding, constantly doing something. But the market rewards patience more than activity. When you wait for confirmation before adding, you're not being passive, you're taking an active position in discipline. You're betting that mathematical precision beats emotional conviction. Patience becomes profit. But only if you abandon the amateur's bigger is better mentality and embrace the professional's mathematical precision. The amateur adds to winners randomly, based on how good they feel about the trade. The professional adds to winners systematically, based on what the market proves about the trade. Feelings lie, mathematics doesn't. Here's what separates the survivors from the casualties. The survivors understand that building winning positions is not about being right. It's about being right in the right size, at the right time. The 1/4 rule ensures that when you're right in a size that protects you when you're wrong. When you're wrong in a size that doesn't destroy you. Evidence first, addition second, ego never. Your job is to codify rules that cage fear and starve greed of oxygen. Never add to a loser. If price sinks below your line in the sand, you exit. No debate. Press right slowly, and mathematical precision will build compounding momentum without attracting catastrophic risk. The exact protocol for when to add, how much to risk, and where to place your stops that's coming next. Keep watching. Amateurs think pyramiding means adding equal amounts to winning positions. This is their first mathematical mistake, and it's devastating. They buy 100 shares at $50, add 100 more at $53, then 100 more at $56. Their average cost climbs to $53. When the stock pulls back to $52, their entire 300-share position shows a loss. They've transformed a winning trade into a loser through careless mathematics. You confused being right with being big. The market punished you for poor arithmetic, disguised as confidence. This isn't bad luck. This is mathematical inevitability when you pyramid incorrectly. Equal additions create equal exposure at each price level. Your $50 entry carries the same weight as your $56 addition. When the stock reverses, your higher-priced shares drag down your entire position. You built a house of cards where every floor is equally vulnerable to collapse. In 1909, Jesse Livermore faced this exact decision with wheat futures. He bought 10,000 bushels at $1.20, convinced grain prices would rise based on crop reports and supply fundamentals. When wheat hit $1.30, confirming his thesis with strong volume and institutional buying, every instinct told him to double down. 10,000 more bushels would double his profits if he was right. But Livermore didn't add another 10,000 bushels. He added exactly 2,500 bushels, 1/4 of his original position. Think about the discipline this required. Wheat was moving exactly as he predicted. His analysis was proving correct in real time. The natural human response is to press harder when you're winning. But Livermore understood something most traders never learn. Being right doesn't mean betting bigger. It means betting smarter. At $1.40, wheat continued climbing. Again, Livermore could have added another 2,500 bushels to match his first addition. Instead, he added 625 bushels, exactly 1/4 of his original position size, not 1/4 of his current holdings. Notice the pattern. Each addition gets smaller, not larger. This defies every emotional impulse about winning trades, but it creates mathematical superiority. The 1/4 pyramiding rule operates on mathematical precision that removes emotion from position building. Your original position represents your largest allocation, placed at a clear, pivotal point where you have maximum conviction. Your first addition equals exactly 25% of your original size, triggered only after market confirmation. Your second addition again equals 25% of your original size, not 25% of your current total. This distinction is crucial. The original position becomes your mathematical anchor for all subsequent additions. Maximum additions should never exceed 3 to 4 layers total. More layers create complexity without improving returns. They increase your average cost unnecessarily and create too many decision points during volatile markets. Simplicity in structure creates clarity in execution. Consider the mathematical reality through concrete numbers. You buy 100 shares at 50, investing $5,000. The stock moves to $53 with confirmation, and you add 25 shares for $1,325. At $56, you add another 25 shares for $1,400. Your total position is 150 shares costing. Your total position is 150 shares costing $7,725, creating average cost of. Creating average cost of. Frakshu. 725. 150. 50,5 per share. Compare this to the amateur's equal additions. 100 shares at 50, 100 shares at $53, 100 shares at $56. Total cost, 20,000, plus 5,300, 5,600, 15,99439, shares. Average cost, 4,399 shares. Average cost, 4,399 shares. Average cost, frac $15,900, 300 equals $53. The 1/4 rule keeps your average at $51.50, a full $1.50 buffer against reversals. This $1.50 difference represents survival margin. When the stock pulls back to $52, the amateur's position shows a $300 loss on 300 shares. Your position shows a $75 profit on 150 shares. Same stock movement, opposite outcomes, purely due to mathematical structure. If the stock falls to $51, the amateur faces a $600 loss while you show a $75 loss. The 1/4 rule transforms your risk profile completely. The mathematics create an inverted risk pyramid. Your largest position should always be your safest position. The original 100 shares at $50 represent your highest conviction entry at the most favorable price. Each addition carries higher risk because it's made at higher prices with less margin for error. The 1/4 rule ensures your riskiest positions remain your smallest positions. Your base layer carries the lowest risk and highest size. Each additional layer carries higher risk but smaller size. If the trade fails, your losses concentrate in the smaller, riskier additions, while your larger, safer base position minimizes damage. This isn't about being conservative, it's about being mathematically optimal. Pattern interrupt. Doing less often makes you more. The market rewards mathematical discipline, not emotional conviction. When you're winning, every instinct screams to bet bigger. But professionals bet smarter, not bigger. They understand that position sizing is risk management in disguise. Professional traders take unequal risks at unequal prices, with their smallest risks at the highest prices. The mathematics compound over time. A trader using equal additions might win 60% of trades but lose money due to poor sizing. A trader using the 1/4 rule with the same win rate makes consistent profits through superior risk-adjusted returns. Your largest position should always be your safest position. This maxim guides every addition decision. When tempted to add more because you're winning, remember that winning doesn't equal safety. Your original position at the best price remains your safest bet. Next, we'll reveal the 3 confirmation gates that separate profitable additions from costly mistakes. Amateurs add to winners randomly. They see green and click buy. No confirmation, no plan, no discipline. Result, they pyramid into temporary moves instead of sustained trends, turning mathematical advantages into emotional disasters. You've done this. Your stock pops 3% on weak volume, and you add shares because it feels right. Then it reverses the next day, transforming your addition into dead weight. You confused movement with momentum, noise with signal. This isn't bad luck, it's the inevitable consequence of trading emotions instead of evidence. The amateur sees any upward price movement as validation. They add during consolidation, hoping for breakouts. They add during pullbacks, hoping for reversals. They add during gaps, hoping for continuation. Hope drives every decision. Mathematics drives none. This random addition strategy destroys more accounts than bad stock picks ever will. You're essentially stacking chairs in a storm while professionals build fortresses one confirmed brick at a time. Picture Jesse Livermore in 1915 with Bethlehem Steel, one of the most crucial trades of his career. He identified steel as a play on wartime demand, with Europe consuming massive amounts of American steel for the war effort. He bought his initial position at $85, just below major resistance at $90. This wasn't random. He positioned himself at a clear pivotal point where he could define his risk precisely. The stock drifted sideways for days. Livermore watched, waiting, holding his original position while other traders grew impatient. Amateur traders would have added during this consolidation, thinking they were averaging up on a winner. But Livermore understood something crucial. Sideways movement proves nothing. It's neither confirmation nor denial of your thesis. It's simply time passing, and waiting becomes a position. Then it happened. Volume spike, range expansion, decisive breakthrough $90 resistance to $92 with authority. That's when Livermore added his first 25% increment. Not before, not on hope, not because he was bored. Only after the market proved his thesis with unmistakable confirmation. The market had spoken clearly. Institutional money was entering Bethlehem Steel with conviction. He bought the leaving, not the lying in wait. This is where the three confirmation gates separate profitable additions from costly mistakes. Each gate must be satisfied before you risk additional capital. Gate 1, pivotal point break. Your addition must come after a decisive move through significant resistance or support, not during the approach. A pivotal point isn't just any price level, it's where supply and demand have battled before, creating clear historical significance. When price breaks through these levels decisively, it signals that the balance of power has shifted. The key word is decisive. A tentative probe above resistance that immediately retreats isn't confirmation. A sustained break that holds for multiple hours with increasing participation is confirmation. The market must prove the breakout is real, not another false start. Gate 2. Volume confirmation. Trading volume must exceed 120% of the 20-day average on the breakout. No volume, no add. This rule eliminates most false breakouts immediately. Price can be manipulated temporarily, but volume reveals true institutional interest. When large institutions accumulate positions, volume spikes dramatically above normal levels. The 120% threshold isn't arbitrary. Analysis of thousands of breakouts shows moves with volume below this level fail 67% of the time, while moves above 120% succeed 71% of the time. Volume is the fuel that drives sustainable price movements. Without fuel, the move dies. Gate 3. Price persistence. Your addition must stay profitable for at least 2 trading sessions. If it immediately reverses, you added too early. This gate eliminates the trap of adding on day 1 breakouts that reverse quickly. True institutional accumulation creates sustained buying pressure that persists across multiple sessions. 2 trading sessions isn't random. It's the minimum time required for institutional orders to execute fully and for the market to absorb selling pressure from profit takers. If your addition can't stay profitable for 48 hours, the breakout lacks conviction. The professional's timing follows this exact sequence. You don't add because you're up 5%. You add because price breaks through a pivotal point with authority. Volume confirms institutional participation, and the move holds for 48 hours, proving staying power. Pattern interrupt. You don't need to predict. You need to confirm. The market tells you when to add, if you're disciplined enough to listen. The mathematical reality proves this approach works. Livermore's trading records from 1,900 to 1,920 show that additions made with all 3 confirmations succeeded 73% of the time. Additions made with only 1 or 2 confirmations succeeded just 41% of the time. Each gate you skip doubles your failure rate. Think about what this means. If you make 10 additions per year using all 3 gates, 7 will be profitable. Skip gates randomly, and only 4 succeed. Remember the 25% sizing rule from Chapter 2. It only works when combined with these confirmation gates. Size without timing is gambling. Timing without size discipline is speculation. Together, they create mathematical edge. The 25% rule ensures you don't risk too much on any addition. The three gates ensure you only add when odds favor continuation. Your largest position should always be your safest position. Next, the exit strategy that protects your entire position stack when the tide turns. Traders who master the 1/4 entry rule often butcher the exit, treating their layered position like separate trades instead of one coordinated stack. This is where mathematical discipline breaks down into emotional chaos. They keep profitable layers when the stack fails, turning mathematical winners into devastating losses. You've built your position perfectly, followed every confirmation gate, sized each addition precisely at 25%, and watched your stack grow profitably. Then the market turns. Instead of protecting your gains systematically, you start making individual decisions about each layer. Fatal mistake. The amateur thinks in fragments. My original position is still profitable, so I'll hold it. My first addition is break even, so I'll hold that too. Only my second addition is losing, so I'll cut that. This fragmented thinking destroys more fortunes than bad entries ever will. You're treating a coordinated position like separate bets, each with its own logic and exit criteria. But position stacks don't work that way. They succeed or fail as unified structures. In 1917, Jesse Livermore pyramided U.S. Steel perfectly from $95 to $115, a textbook example of the 1/4 rule in action. His original position entered at $95, just above support with clear risk definition. When steel broke through $100 resistance with volume confirmation and held for 3 sessions, he added his first 25% increment. At $108, after another confirmed breakout, he added his second 25% layer. The stack was mathematically perfect. Steel peaked at $115, giving Livermore substantial unrealized profits across all 3 layers. Then the market shifted. Steel reversed to $110, triggering his trailing stop system. Here's where discipline separated Livermore from the masses. Instead of exiting the entire stack as his system demanded, he made an emotional decision. He kept his original $95 position because it was still profitable. That single deviation from stack discipline cost him a fortune. Steel didn't stop at $110. It crashed to $88, turning his mathematical winner into a devastating loss. His original position, the one he kept because it was still profitable, became a massive loser. The lesson is brutal but clear. When a position stack fails, everything must go. Your thesis was wrong if the stack is failing. Individual layer profitability becomes irrelevant when the overall structure collapses. The stack exit system operates on 3 non-negotiable pillars. First, implement a unified stop loss. One trailing stop for the entire position stack, not individual stops for each layer. Your pyramided position is a single, integrated unit. If the market invalidates your thesis for one layer, it has likely invalidated it for the entire position. Second, employ the 50% trailing rule. Set your trailing stop at 50% of maximum unrealized profit from the peak. This isn't arbitrary, it's a carefully calculated balance between protecting gains and allowing normal volatility. Third, enforce an all-or-nothing exit. When that unified stop triggers, you exit everything original position and all additions simultaneously. Mathematical example. Your position stack shows $8,000. $8,000 unrealized profit at its peak. According to the 50% trailing rule, your unified stop loss sits at $4,000. $4,000 profit, exactly half of maximum gains. If the market reverses and your unrealized profit drops to $4,000, your stop triggers. You exit the entire stack immediately, banking a guaranteed $4,000. $4,000 profit. Instead of hoping for recovery back to $8,000, $8,000, compare this to the amateur's approach. They might see the profit drop from $8,000, $8,000 to $4,000, $4,000, and think, it'll come back. They hold, hoping for recovery, only to watch profits erode to zero or turn into losses. You, the professional, walk away with substantial, realized gains. Risk management integration ties everything together through the 1R concept. Your total position stack original plus all additions should never risk more than 1% of your trading capital. If your account is $100,000, your maximum risk per stack is $1,000. $1,000. The unified stop ensures that as positions move in your favor, you're protecting increasingly larger profits while maintaining disciplined risk exposure. The professional's mindset differs fundamentally from the amateur's approach. When the unified stop triggers, the professional understands that their edge is gone. Everything must go. The market has provided new information that invalidates the entire premise of the trade. The amateur thinks, my original position is still profitable. The professional thinks, my edge is gone, protect what I've built. Pattern interrupt. Protecting 50% of your maximum gain beats hoping to recover 100% every single time. Hope is not a strategy, it's a psychological trap that transforms winners into losers. The mathematics are unforgiving. A position that loses 50% from its peak needs a 100% gain just to return to break even. These aren't favorable odds. Your largest position should always be your safest position. But even safe positions fail when market conditions change. The stack exit system ensures you preserve capital when your thesis proves wrong, regardless of individual layer performance. It's not about being right, it's about staying in the game long enough to be right when it matters most. Cut the entire stack fast. Press individual winners slow. This maxim captures the asymmetric nature of professional trading. You build positions gradually, with confirmation at each step. You exit positions immediately when the structure fails. Speed matters more on exits than entries because failing positions accelerate downward faster than winning positions climb upward. The final piece, the psychology that makes or breaks this entire system. Even perfect rules fail without perfect execution. This is the brutal psychological reality that destroys more trading careers than market crashes, economic recessions, or black swan events combined. Fear makes you hesitate on confirmed additions when every signal screams, buy. Greed makes you abandon the 25% sizing rule when you're convinced you've found the trade of the century. Hope makes you hold failing stacks when your unified stop-loss demands immediate exit. The market finds your emotional weak spots and exploits them ruthlessly, turning your mathematical advantages into emotional disasters. You can memorize every principle, understand every confirmation gate, and still lose money because emotions hijack your decision-making at crucial moments. Consider Sarah, a trader who mastered the 1/4 rule perfectly for 3 months. She followed every confirmation gate religiously. Her position sizing was mathematically precise at exactly 25% of original positions. Her exits were disciplined through unified stop losses. She built consistent winners, compounding her account steadily through careful application of pyramiding principles. Her confidence grew with each successful trade. She began to believe she had conquered the psychological demons that plague most traders. Then came a strong market rally in technology stocks. Sarah identified a breakout in a semiconductor company with all 3 confirmations. Decisive breakthrough resistance at $85, volume exceeding 150% of the 20-day average, and price persistence for 3 full trading sessions. Every signal aligned perfectly. Her system demanded a 25% addition to her original 100-share position, exactly 25 shares. But overconfidence whispered seductively, this is different. This is the big one. All confirmations are stronger than usual. Sarah rationalized abandoning her 25% rule. Instead of adding 25 shares, she added 100 shares matching her original position size. It's such a sure thing, she told herself. The confirmations are so strong. Why not maximize the opportunity? This single deviation from mathematical discipline destroyed 3 months of careful profits. When the technology sector corrected 2 days later, her sure thing became a devastating loss. Her emotions, not her system, had taken control at the worst possible moment. She had stopped being a rules-based operator and became a hope-based speculator. The discipline framework exists to prevent exactly this scenario through 4 interconnected protocols. First, pre-market. Planning eliminates real-time emotional decisions. Before markets open, write down your exact position sizes, addition triggers, and exit stops for every active trade. No hallway decisions. No feeling it out during market hours. Every critical decision gets made when emotions are calm and logic dominates. Your plan becomes your battle map. Deviate from it at your peril. Second, mechanical execution removes willpower from the equation entirely. Use bracket orders to automate additions and exits. Set your original entry, your first 25% addition trigger, and your unified stop loss simultaneously. If your broker offers conditional orders, use them to trigger additions only when confirmation gates are met. The less you have to think and react in real time, the more consistently you'll execute your plan. You're not faster than impulses during live market action. Third, position journaling creates awareness that prevents impulsivity. After each addition, record your emotional state and confirmation quality in 2 lines. What you felt, what the tape showed, and which confirmations were present. Were you excited, fearful, or calm? Did all 3 gates trigger clearly, or were you stretching criteria? This written record reveals patterns in your decision-making that you can't see during execution. Fourth, weekly review grades each addition as A, B, or C based on confirmation strength and rule adherence. A-grade additions had all 3 gates triggered decisively with perfect 25% sizing. B-grade additions had solid confirmations but minor concerns. C-grade additions involved stretching criteria or emotional decisions. Press more A-grade setups next week. Eliminate C-grade trades entirely. This continuous improvement process refines your edge systematically. The professional's edge comes from understanding a fundamental truth. Amateurs trade their opinions. Professionals trade their process. The 1/4 pyramiding rule isn't about being right about market direction. It's about being consistently disciplined when you are right. Your opinion might be correct 60% of the time, but without disciplined execution, that 60% win rate becomes unprofitable due to poor sizing and emotional exits. Pattern interrupt. Your biggest enemy isn't the market. It's the voice in your head saying, just this once, break the rule. That voice sounds reasonable. It presents compelling arguments. It promises exceptional rewards for small rule violations. But that voice has destroyed more trading accounts than any external market force. The market is neutral. Your internal voice actively works against your long-term success by prioritizing short-term emotional satisfaction over mathematical discipline. 4 maxims guide daily practice. Green makes you bigger. Red makes you smaller. Winning positions earn additions. Losing positions get cut. Never add to a loser, not once, not ever. Adding to losing positions transforms small losses into account-threatening disasters. Waiting is a position. Patience isn't passive. It's actively preserving capital for high-probability setups. Size small, add smaller, exit fast, conservative entries, disciplined additions, immediate exits when conditions change. You now have the complete system. 25% additions only after 3 confirmations, unified stack exits at 50% trailing stops, and mechanical discipline that removes emotion from execution. This isn't about getting rich quick, it's about getting rich mathematically through consistent application of proven principles over time. Actionable recap. Start with 1% risk per trade maximum. Add exactly 25% of original size only after 3 confirmations. Trail stops on entire stack at 50% of maximum profit. Cut failing stacks completely, no exceptions. Own your process, not your opinions. If this showed you how to build winning positions, the next lesson reveals how to spot distribution before it cuts you. That's where the real money is preserved.